The market isn't looking too great today, and in fact we are taking a look at 6 companies that reported today before the market opened, and each one of these have performed fairly poorly in terms of the share price. Now the first one we're looking at is Moody's Corporation. As we can see, down around 4%. We're going to have a quick look at each one, get to our own valuation, and some of these we don't believe right now are a buy and do look to be a bit overvalued. So MCO over the last 12 months, still a very strong performance, up 51%. Over the last 10 years, significantly outperformed the S&P, up 370%. It is, even after the dip, still trading towards its 52-week highs. We get one buy rating from Wall Street with a hold from Seeking Alpha and Quant. It does pay a yield, however fairly small at 0.7%, and it does have what we would consider to be a very high forward P at around 42. Bear in mind, overall S&P right now is around 25. In terms of their earnings, well, we can see here they do expect growth over the next few quarters, although quarter 4 they are pretty much expecting it to be flat on a year-on-year basis. We also note from the previous 4 quarters, they have missed on one of them, giving them a 75% track record. And no surprises with EPS growth anticipated over the next full year, given the very high forward P. This is expected to come down, although still very high at 37.45. In terms of looking at the dividend safety score, well, 83, very safe. When we do typically look in detail, we analyze dividend yield theory. This would be a sign of overvaluation. And again, even after the drop today, based on the forward P, we get our own overvaluation signal here. Nice to report though, this company does typically increase the dividend at a double-digit rate, 10% as we can see here, just in February this year. Now, in terms of looking at the valuation, as always on this channel, when we do deeper dives, we look at every single one. We run through the inputs, the outputs. We discuss whether or not each model shows undervaluation or overvaluation. Getting straight to it today, our valuation of $454 indicates right now this company is trading at a premium. So what we would typically do is add a 10% margin of safety, and we would execute it on a company like this, which has 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. For that 10% MOS, it would need to come down to $408. Even for those that are happy with a 5% or even buying this exactly at its intrinsic value, as we can clearly see, this company, in our opinion, is trading at a premium. In terms of Wall Street, well, they have a different perspective. They believe there is some upside, although fairly minimal at 8%, with a price target of $505 over the next year. As always, give us your thoughts below on each of these stocks. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we talk about undervalued stocks that we believe deserve your attention, as well as what's gone over the market in the last few days. So do click on the pinned comment below, sign up, and you can read straight away. You'll also be able to gain access to 36 undervalued stocks for the month of October. We run through each one, a lot of information. We talk about the upside that Wall Street themselves see over the year, and we also flag those that sit within our own portfolio. On top of that, for the month of October, you can grab 22 dividend stocks that Wall Street themselves believe have the most upside out of every company in the S&P. So again, click below, sign up, and you can read these straight away. We then move on to Lockheed Martin, where we get a 5.5% drop today. Nonetheless, up 30% over the last 12 months. Over the last 10 years, still outperforming the S&P, up 205%. As we can see, still trading towards the upper end of the 52-week range. Double buy rating with the hold from Quant. Forward yield, well, that is looking higher than the previous at 2.15%, and a forward P around 23.14. In terms of forward expectations, well, we can see they aren't anticipating growth every single quarter, but over the previous quarters, this is a company by quite some distance has been outperforming management and their targets. With the growth expected over the next full year, their forward P will come down to around 21.73. In terms of their dividend safety, well, a very safe score at 84. We get overvaluation based on dividend yield theory, overvaluation based on the forward P, with an increase to the dividend just this month at 4.8%. As you know by now, this isn't something we do like to see on the channel, as that is pretty much at a bare minimum, just keeping up in line with inflation. Now, very similar to Moody's, we have a company here where we see the intrinsic value right now lower than the current price. So if you are buying this company, in our view, it is trading at a premium. But just for transparency, for those that want to see a 10% MOS at buy at 515, at 15% around 486, and at 20% around 457. As always, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for Lockheed Martin or any others. We also know, again, very similar to the previous company, Wall Street do see upside of around 6%, but not enough in our opinion to get us interested. We can see $616 price target over the next year. We then move on to Verizon, down around 4.5% after their earnings earlier. We get a double buy rating, again another hold from Quant, trading in the mid to upper end of the 52-week range. Probably the highest yield we'll cover today at 6.2%, a forward P of 9.57, up 33% over the last year, not far off the S&P. Over the last 10 years, however, we do see it down around 17%, but will depend at which point you bought. As we can see, this came all the way down to around $30 just a year ago. In terms of their earnings expectations, well, they are expecting growth over the next few quarters, and out of the previous, as we can see, at a bare minimum, they are either in line or a beat. And with the EPS growth, forward PE coming down, although marginally, to 9.27. Dividend safety, great to see a safe 70 score for a company that does pay a nice yield. We get undervaluation based on dividend yield theory, reasonable valuation based on the forward PE, with a very mediocre increase just last month at 1.9% to the overall dividend. Our intrinsic value, well, $45, so it does mean in today's episode, you aren't too far off a 10% MOS, sitting somewhere between 5 to 10, 5% at $42, and as we just saw, 10% around $40. In terms of Wall Street, well, they are still very bullish, $48 price target, 15% upside, which you could argue is pretty good for a company that right now yields more than 6%. We then move into the construction industry, PACCAR Incorporated, with a triple hold right across the board, trading in the mid to lower end of the 52-week range, a nice yield of 4%, a forward P of 13.5, respectable performance up 23% over the last year. Over the last 10 years, up around 130%. We can see all-time highs beginning of this year around $125. Now, do understand, construction industry, very cyclical. Therefore, we can in fact see over the next 4 quarters, they are expecting a decrease to the year-on-year EPS. And they also, something to flag here, are expecting over the next full year, the earnings to fall. Therefore, although marginally, increasing that forward PE to 13.65. Great to see a very safe dividend score, but we do get overvaluation based on both the yield as well as the forward PE. Something that is quite nice to note is that they did increase the dividend at 11% in May this year. In terms of our valuation, well, $112. We do see a margin of safety, not enough for the 10% at around $101. You are getting 5% now, but again, for a company like PACCAR, you probably are looking for a lot more. So at 15%, a buy around $95, at 20% around $90, and at 25% around $84. As we said, just 5% today. With Wall Street, whilst they see upside of 13%, probably not enough to consider as a new position, $118 price target over the next year. We then move on to Kimberly-Clark, down 4% today, up 13.5% over the last 12 months. Over the last 10 years though, massive underperformance of the S&P, up 21%. Also very, very inconsistent, lots of ups and downs just over the last few years. Right now trading at the mid to upper end of the 52-week range, a forward yield of 3.4%, forward P just under 20, and just one buy rating right now from Seeking Alpha. In terms of the 4 quarters, well, we do see a lot of inconsistency, some growth, some decreases, and also a 75% previous track record. Nonetheless, growth anticipated to the EPS next year, lowering the forward P to 18.88. We get another very safe score at 88 with a reasonable / slight undervaluation both on the yield as well as the forward PE, and a subpar increase to the dividend at 3.4% in January this year. When we get to the valuation, well, a 10% margin of safety would indicate a buy at $134. Not quite there yet, not too far off, so you could say near a 10% margin of safety, with Wall Street giving this 12% upside, $154. And that is something again to consider, but ultimately you probably would want more upside and a larger MOS, 15% a buy at 126, at 20% around 119, and at 25 around 111. As we said though, sitting between 5 to 10% in today's episode, and do give us your thoughts below. We then move on to the final company, General Electric, down 7.5% today, although we do get a strong buy rating from Wall Street, a buy from Seeking Alpha with a hold from Quant, trading at the upper end of the 52-week range, a forward yield 0.58%, a very high forward P at 46, but very strong performance, up 68% just over the last year. Over the last 10 years though, not the greatest graph, down 13%. In terms of earnings, again, inconsistency over the next 4 quarters, but they are expecting some quarters to show some large growth year on year. Previous 4 as well, 100% track record, and a nice increase expected over the next full year. Still high forward PE, but lowering it down to 37. In terms of dividend safety, well, 70 score, undervaluation on the yield, overvaluation on the forward PE, and they have increased that dividend significantly just in April, but bear in mind this company has cut the dividend in the past. Then we move on to our valuation. Well, for this company, pretty similar to the majority today, we do see it trading right now at a premium. Our intrinsic value of $161 would mean a buy at $145 if a 10% MOS was something you were looking at. 15% 137, 129 at 20%, and at the 25% point around the $120 mark. So no margin of safety for this company. However, Wall Street, we did get that strong buy rating. Their price target $210 with upside of 17% over the next year. As always, give us your thoughts about these 6 stocks below. Are you adding to any of them? Maybe you're holding, or perhaps you do see them as overvalued and are looking to sell. If you enjoyed today's episode, well, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.